We are about to start. I'm hitting the start button.
We can probably watch the attendee number, Paul, and as that goes.
Okay, well, I think we're live. I see people are joining as we're going here, so we might as well get going. We want to be on time. I guess we're maybe 1 minute early, but people will be joining over the next couple of minutes. But we might as well start. So, welcome everybody, viewers at home or in the office. Hopefully, you are doing well and safe and have good internet for today's informative conversation around assessments and appeals and taxes. My name is Paul McKinnon. I'm the CEO of Downtown Halifax Business Commission, and I'm very pleased to be joined here today by the other 4 urban core business improvement districts and their leaders. And I'm going to introduce them, and they're going to give a little wave as I do so, and I'll just go in the order that they appear on my screen. It may be slightly different on your own screens, but I'm going to say a big shout out there to Carla Nicholson, represents Quinpool Road and area. We've got Tracy Jackson, who's with the North End Business Association. Tim Rosesco from across the harbor in downtown Dartmouth. And last but certainly not least, Sue Utek from the Spring Garden Area Business Association. So we partnered today, and it's, I mean, this is something that we've done in the past. This is, I think, is the first time we've done this fully virtually, but of course we're all used to that now. It is assessment season throughout the city. So if you're a landlord, you would have, excuse me, you would have received your assessment over the past couple of weeks. We as business improvement districts actually just received our entire area assessment. So we've got access to everyone's assessment data. And so, I mean, like everything else, COVID has in some cases impacted assessment. Certainly it has impacted businesses. And so I think there was probably more interest than ever before in this year's assessments and seeing what the impact on business would have on assessments. If you're joining us as a tenant, you may or may not have access. Or you wouldn't have received a notice about the assessment for the property that you're in, but all that information is publicly available, so you can check out and see what the assessment looks like for the property that you're in. And when we get forward to talking about appeals, there's a role that you can play in the appeal process as well. So. With that, I'm going to wrap up my speaking. I'm very excited to introduce our expert panelists today, and they're all joining us today from Turner Drake. They are Giselle Kakamousias. I almost got that right. Giselle, we've got Andre Pouliot. Is that right? Man, I should have practiced these names beforehand. Yeah. And Greg Carey, I'm assuming that's how it's pronounced.
That's the ones that lay up.
Yeah, there we go. So they're going to stay on, and over the next hour or so, we're going to have a conversation about generally what's happening with assessments, kind of some different trends that are occurring in the different areas that we're talking about today. And what I would invite people to do as we go along is there is a Q&A function at the very bottom. The chat function's been disabled, so don't try to chat, but the Q&A function, if you have questions, please put them forward in there. We'll try to monitor those as we go along, but if not, there will be a time at the end when we'll try to get to all those questions that you may have. So with that, I'm going to ask my fellow bid panelists. We're going to not sign off, but we're going to disappear, and you'll be left with the speakers. And hopefully you will find the session very informative. Thanks very much.
All right. So are we seeing the presentation on the screen? There we go. All right. 1 second here. All right. Okay, so we're cooking with oil. So thanks very much for the invite to speak with you today. I've had the pleasure of knowing many of the BID executives for years, and I know they work tirelessly behind the scenes on this whole taxation piece, including quarterbacking, having us here today to speak. And I speak with experience when I say that this whole tax racket is a lot to keep track of. I've been in the industry for coming up on 30 years now, all of them with Turner Drake, incidentally. And one thing that I've come to realize is that the property tax and assessment regime is constantly evolving. My colleagues and I, who will be speaking with me today, do our best to keep abreast of those changes. And today, we're going to try to bring you into 2022 and bring you up to speed on a topic back to many as a bit of an enigma wrapped up in a riddle. And I appreciate that out there in the audience. We have some folks with a wide spectrum of knowledge on this topic. Let's just see here. I'll get you to bring up the agenda if you don't mind, Kim. And some of you are very sophisticated, while others are focused on running your businesses, obviously, and might not have that same knowledge base. So with that in mind, we've tried to pull together an agenda that provides a bit of something for everybody. And because no one wants to sit and listen to me talk at a screen for an hour, I have two of my colleagues and all around favorite people actually with me here today. Andre Pouliot, our senior manager and vice president, with whom I've worked directly for all of my 25 years all of his 25 years of his career at Turner Drake, and also Greg Carey, who's our manager and my Nova Scotia wingman. And Greg brings over 10 years of knowledge, and I'm going to hand things over to him now. So if you could flip the slide, please. I'll get Greg to talk to you a little bit about the basics of property tax.
Thanks, Giselle, and thanks everybody for tuning in today. So let's just sort of start from the start with property taxes, really get down to the nuts and bolts of things. And so every year is a new assessment year, and the basis of your assessed value is quote unquote market value. What we mean by that is, that's subject to some different pieces of legislation, some time delays, that sort of thing. So it's intended to be representative of what your property or the property that you're a tenant in is, again, quote unquote, worth. And that's not to say how much money it would take to pry the property from your hands. It's, a willing buyer and a willing seller in an open market. And there's a couple different qualifications for market value, but generally speaking, it's just, if you put your property in the market, what would it sell for? Again, with about 40 asterisks. The assessments are calculated by the PVSC. That's the Property Valuation Services Corporation, which is a not-for-profit corporation that's technically owned and financed by the municipalities. And they're essentially the assessment authority in Nova Scotia. So they set the assessments. So this is the one that everybody wants to listen to, is your property taxes. And that's the function of two values, okay? So first is the assessed value. And that is, again, the market value of the property that you own, that you're in, what have you, multiplied by the tax rate. Now, the tax rate for this year, it's set every year in about August for the upcoming 12 months. The residential rate, and this includes multifamily residential, is 1.196%. The commercial rate is 3.394%. And in most and or all the BIDs, there'd be a very small additional levy that helps to do business improvement district specific marketing, so Spring Garden, downtown, what have you. Any initiatives that they do specific to their geographies, there's usually a very small piece on top of that. And so for this year, assessment notices were mailed last Monday on the 10th, and the assessment appeal period is open for 31 days. And this is a pretty hard and fast rule. There are very few, if any, exceptions to this. So if you don't appeal your assessment, and we're going to get into how that's done, what that looks like, all that sort of thing. But if you don't appeal within that 31 days, you are out of luck. Appealing your assessment doesn't mean you're obligated to, go to court over it. It just means you're registering the first step. So if ever you're in doubt, you should probably appeal it and work out the details after. And again, that can be withdrawn at a later date to basically no penalty. So really it's a very low risk and can be a, mildly high reward endeavor should your property warrant some kind of reduction. And so what we do at Turner Drake is deal with the assessed value side of things. The tax rate, there's very little that you can do about that. That's set by the municipality again every year. And there's lots of math that goes into it, but basically it's the city's spending divided by the entire assessment roll, and that's your tax rate. And again, commercial pays more than residential, et cetera, but that's broadly how it's calculated. So there's nothing you can really do about the tax rate. So it's that assessed value where you can really dig in. Kim, if you just want to move forward, slide for me, thank you. So let's talk about a bit more of the basics. The assessment date this year is January 1st, 2022. So we talk about it as in this is the 2022 assessment year. But the thing with assessments in Nova Scotia is that we're basically always 1 month in delay. So it's the economic value of the property as of January 1st, 2021. Now, this is going to get confusing, but just try and stay with me. So it's the economic value. What would it have sold for a year ago, basically, with regard to the physical state of the property as of the start of December. So just this December past. So basically what's that saying is what would it have sold for a year ago but they try and have this physical, they call it the state date. That's to encapsulate any renovations, improvements, new construction, and demolitions, should that be relevant to your property, although they're frequently less keen on picking up the demolitions than they are the renovations. But broadly speaking, it's the market value of your property as of January last year. And in Nova Scotia, every year is a new year. And it's important to keep that in mind, especially with COVID, because for the 2021 assessment year, for last year, COVID wasn't technically relevant. Basically, it was assessments as of December 1st prior to COVID, but now this is the market value as of January 1st, 2021. So we are right in the thick of the pandemic. So a lot of the downtown properties is going to be extremely relevant. Kim, if we can just move forward one. Awesome. So for commercial property, the same dates apply. And oftentimes what you would want to estimate your assessment moving forward would be at about 90% of the price within 2 years. And again, like I said, they normally don't get it on the very first year when your property sells, but they will normally catch it eventually. So if a property sells, if the property that you're a tenant in sells, as significantly more than the assessment, you can expect to see the assessed value and therefore your tax bill increase to about 90% of the sale price within 2 years. Within commercial properties, there's more heterogeneity in terms of both the methodology and the properties themselves. And there is no cap program for commercial properties. So the capped assessment program, the CAP, is on residential properties, single family homes with a couple different qualifications, but those are limited to CPI more or less. And so commercial properties don't benefit from that. And again, with regards to sales, a share transfer of a property normally won't trigger the same kind of reassessment that the sale of just the property will. So when there's a transfer of the deed, the PVSC gets a copy of that. Whereas if you're buying a business and its only asset is a property, when you buy that, that doesn't get registered in the same way. And normally that goes under the radar. And so the sort of take home message from that is, if you're ever buying a business and the only asset is physical real estate, you should probably just buy the business as a whole rather than trade the building, because likely you'll get away with a more favorable assessment situation on the back side of that. Kim, if we can just go forward. All right, so some things to keep in mind when we're talking about assessments, and this is important, and Giselle likes to bring this up as sort of a footnote, and I've picked it up off of her, is that assessment is based on mass appraisal, and it's, our neighbors, it's some of my former colleagues who are on the other side. These aren't bad people. They're not out to get us. They don't look at your property and say, this guy specifically. It's based on mass appraisal. They've got 600,000 properties to assess, and they need some way of doing that in a timely fashion. So what they do is they model the properties. They say this bundle of office buildings on the peninsula, downtown, what have you, they rent for on average something like this. Their vacancy is something around this much, 5%, what have you. So if your property doesn't fall into the mold that they've prescribed, it's worth a second look. So the way that you have your property reviewed, again, if it doesn't fall into the mold, and in a city, like in a jurisdiction like Halifax, lots of properties don't, especially when you've got heritage properties and old properties, new properties, underutilized properties, all these sorts of things. We don't have quite the same buildup, obviously, as Toronto. So, buildings are much more individual in a place like Nova Scotia than some other jurisdictions. So if you don't fall into the model, you should think about maybe challenging it. And the way to do that is by filing an assessment appeal. You've also got the opportunity for what they call advanced notification. And that's normally done in the fall, where you can work on your assessment in conjunction with the assessors prior to the assessment roll being published. But right now, what we're talking about is the assessment appeal period. And that's basically you file some paperwork that says to the PVSC, I want to challenge this assessment. I don't fall within your modeling, the way that you think this building should be valued. Kim, if we could go forward. Thank you. And so, this isn't going to be news to anybody, but some of the broad asset classes impacted by COVID-19, top of the chain, of course, hotels and hospitality were absolutely ravaged. And we've seen that to roll over. Restaurants, convention centers, not a lot of those going on. Here we are in a virtual Zoom meeting that otherwise might have been in a meeting room downtown. Parkades, when all of the CBDs staying home. People don't need to park as much anymore. Airports, there's nobody else flying. And some more, interesting ones, seniors housing. Well, it used to be sort of common practice that you might get double occupancy rooms, what have you. There's changing and evolving sort of guidelines there. So maybe your facility is now just physically doesn't match what is either legally required or is it best practice or what have you. And you might be in the situation where your building's obsolete by virtue of how it's physically built. Other things, retail obviously had to close down. Offices have been empty and in various degrees of refilling. Schools were underutilized. Not that I imagine there's many school owners here paying taxes. Recreation facilities, gyms, field houses, arenas. I was talking to the PBSC and told point blank that they weren't going to make an adjustment for a fitness facility that I was looking at. So that's one that I'll be filing an appeal on, because they have been closed intermittently and at various levels of full capacity now for close to 2 years. Apartments obviously have been subject to rent control, which is sort of a double whammy, as everybody here is likely aware. The residential housing market has been on fire, which means that property taxes are likely going up, insurance costs are going up, building materials are going up significantly in price. However, apartment owners aren't able to raise their rents to offset some of those costs. And something to keep in mind as well is that partially completed development projects of all classes have been affected substantially. There was huge labor shortages, as well as increases in prices in raw materials. I'm sure everyone's familiar with the headlines of the price of lumber increasing tenfold. And what does that mean if you're trying to build an addition on your business? Is that the price of your renovation just increased by 50, 75, 100% by virtue of the labor and the materials. So, really, there's a ton of different properties that have been affected by COVID-19 and the pandemic, and very few that have been left unscathed. And Kim, if we could go to the next one. So just to look at, obviously, hotels, restaurants, hospitality, the PBSC has reduced assessments across the board, basically from 15 to 25%. And I don't want to say it's arbitrary, but it certainly doesn't seem to have any hard and fast rules. Like most of the larger full service hotels downtown are down 25% on their assessment. Anything outside the CBD or that isn't a full service hotel, a lot of mom and pop operations, smaller hotels and rural municipalities might be down 15%. Some freestanding restaurants saw arbitrary assessment increases in 2021. And there was few changes for 2022, but those 2021 changes still persisted. So even if you didn't increase in 2022, you're likely stuck still with that 2021 increase when COVID technically wasn't relevant. So it's something to keep in mind. And something else to keep in mind is that restaurants were reduced by 15 to 25% in New Brunswick. And we're seeing a lot of the jurisdictions in Atlantic Canada following similar patterns. So it's a bit interesting. Nova Scotia didn't think to reduce their restaurants or hospitality properties in some instances, while New Brunswick did. So again, if your assessment is flat, maybe you went up last year, New Brunswick was down 25%, it might be worth thinking about, should I appeal? Kim, if we get to the next one. Again, under construction properties. And I talked a little bit about this before. Costs are running high, budgets are running high, timelines are running along, and just what the PBSC has done lately is essentially assess properties at 100% of the costs incurred as of the state date, which you're unlikely to pay full dollar for dollar value for a half finished project. Why would you buy somebody else's half completed project for 100% of what they have put into it? There's probably a reason that it came to a halt. And largely the assessments will be reflective of the costs, again, talking about the state date as of the 1st of December. So Kim, if we could just get forward one. Institutional housing, and again, this is something that I touched on earlier. Seniors housing especially has been ravaged both on a personal level and from a physical infrastructure level. And a lot of places will now be running, at 10% vacancy rather than 1% basically vacancy, due to, how the property was built in the 40s, the 60s, the 80s, what have you. What's happened now is that your facility is no longer meets the guidelines that you need to operate safely. So it means either having fewer residents, spacing them out more, what have you. So your physical building is now obsolete, and this should play a part in determining your assessment. Kim, if we can get forward one. Apartments, this is a tough sector right now. Obviously, as I mentioned again, I'm kind of repeating myself, but there's a cap on rent increase, and the Houston government decided to continue with that for the foreseeable future. So apartment landlords aren't able to raise their rents. You know, and there's rising operating costs. Again, property taxes are up substantially, insurance is up substantially, and there's no way to offset these rises in costs. And to go hand in hand with that is the absolutely scorching residential market. We're seeing, you know, single family residential and multifamily sales increasing from 15 to 40, 50%. The prices are just out of control. Kim, if we can get forward one. All right, and let me leave you with this: is what's always relevant, not just, you know, is COVID relevant to my property? Is it having an effect? That sort of thing. Reviewing your assessments is in detail is a critical part of asset management. So basically, it's going to, you know, if you're a building owner, it's a huge operating cost. You know, as far as staying competitive. So it's important to review your assessment, and one, make sure it's accurate, and two, make sure it's competitive with other similarly assessed properties. And my colleague Andre is going to talk to you a bit more about reviewing basic property details and the value. So looking at, you know, the physical details of your property, how the PVSC has determined its assessed value, how they arrived at that value, and then saying, is that value okay? And then what's the effect of the pandemic? Because if that baseline value has problems with it, well, then you've already got a concern. But if the pandemic has, you know, made things worse, then you've got sort of a double whammy, and it's worth, again, looking into. So it's not just COVID-19 that makes your property worth appealing. It's the basic physical property details. So Kim, if we could get forward one more. And with that, like I said, I'll hand it off to my colleague, Andre, who's going to tell you a little bit more about how to verify those details, how to look into your property, and make sure that the PVSC has sort of their numbers right on that end.
That's my cue. So thank you, Greg. Right off the top of my slide, you're going to see the question, is my assessment wrong? And as I go through the next several slides and talk about some of the details, the lens that I'd like you to look through when you ask yourself that question is one where you need to remember that the answer is roughly all the assessments are wrong. Roughly half of them are a little bit too high, some are a lot too high, and the other half are ranged somewhere from a little too low to a lot too low. So there's a 50-50 chance you're on the high side. So it certainly pays to sweat the details when you do an annual review of your property tax assessment. So the PVSC has made it much easier over the last 6, 7, 8 years to do some of that legwork on your own, or certainly to have you know, an agent or an expert do it on your behalf. What they've done, and you can see it circled in the sample assessment notice on the left of your screen, is to include a PIN report with all of their assessments. So that PIN report, if you log in, if you were so inclined, can bring up much more detailed information about the assessment. Gives you an idea as to how the assessment was calculated. And in those PIN reports, if you were to pull one up, you would find that your assessment is going to be arrived at through one of 3 ways. You're going to find, you know, one method is a cost approach, and that would tend to be owner-occupied properties. It would tend to be some freestanding restaurants, although some would be still based on an income approach. It would be big box stores, that sort of thing. Secondly, you might find that it's assessed based on an income approach. And the income approach would be the approach that's used to assess investment properties. So apartment buildings, shopping centers, anything where there's an actual income stream that can be capitalized. And the last one, which we don't see a ton of, is what they call an economic approach. And effectively, it would be say, hey, we're going to assess this building, this apartment building at $50,000 a unit, or $100,000 a unit, simply based on comparable sales. So within that, when you pull it up, what you're going to see, big group of basic property facts. You're going to get building sizes, you're gonna get rental rates, and we're gonna go through all of these as we go through. But one thing that needs to be emphasized as well is that 20 years ago, if assessors were headed to downtown Halifax to do a reassessment, is you'd see a team of assessors out with tape measures and notepads and cameras, and they're walking around and they're measuring buildings and they're picking heights of buildings. We used to measure windows in order to know, to incorporate that detail into the valuation. Today, assessors are relying more heavily on technology. One of those pieces of technology is essentially satellite imaging, and it's oblique imaging of properties that allows you to effectively measure buildings from your desk, and it's fairly accurate. You can measure square footages, you can measure heights, you can do window takeoffs, you can measure doors. So it's a fantastic tool, but certainly it doesn't have the same level of accuracy as going over the tape measure. So that means, once again, some of that refinement is now in the details of an assessment are now being passed on to the property owner to verify. So I'm going to go through each one. I'm going to show you on the next few slides what you're going to see. So if I could get the next slide, please. All right, so this is what you'd see if your property was one of those owner-occupied buildings that are done based on a cost approach. It's fairly small, but I've seen some people asking about the slides, whether they'll be available. You'll certainly be able to zoom in if you get a copy of it later. So what you can see in there, we've got building area, we've got the construction type of the building. So construction type, that means is it wood frame? Is it steel frame? Is it a masonry building? Is it reinforced concrete? The assessor puts in heights, so they'll pick a story height, and that will help the program determine what the replacement cost is going to be. They're going to have details on interior finish. So highly finished buildings are going to have a higher cost than buildings that have less finishes. So, and then you see we've got required capital here. So this is one that we're going to bring up, and you're going to see me mention it again as well. So the first four on the list are pretty static. These things don't change. So it's fairly easy for a computer to update what it would cost to build a building with all of those criteria that you see. It's pretty easy for a computer to, add a couple of % depreciation to a building for it being a year older. But what it can't do is determine if you need a new roof or new windows or a new HVAC system. The only way for assessors to know that is if the owners told them. So that's one piece of information. There's a valid deduction in there for it, but the only way for an assessor to know that is if an owner has advised them. So if I get the next slide, please. So moving on, this is what you'd find in an income approach property. So again, these are your shopping centers. These are small, leased commercial. It could be a property with a retail store on the ground floor, apartments over top. All types of investment property, where a lot of warehouses are done this way as well. And essentially, this approach works by, first by inputting all of the leasable areas in the building. And the leasable areas are then each one of them, each sort of category. So the warehouse space is going to get one rent. The office space is going to get a second rent. The apartments are going to get another rent. Then this will impute a potential revenue for the building. From that, you're going to see deductions for vacancy and expenses. And then the assessor is then going to convert that into a value by dividing by a capitalization rate, which is essentially just a multiplier that equates net income to value. So look, when you're reviewing this, a lot of it's facts. The leasable areas are facts. But what's not a fact is the rent. As you'll see in a moment, the assessment department has modeled rents for all the different types of categories and all the different neighborhoods in the city. But not all buildings are created equal. There's certainly cases where two restaurants right next door to each other, might have different market rents. So it's key to keep in mind that these rents should be market rents. So better space, all else being equal, should rent for more. But secondly, you should also remember that it's not just your contract rent. You could easily be in a situation where you're a great negotiator. You could easily, and you negotiated a great rent. You could easily be in a situation where the rent was negotiated years ago. I like the restaurant examples a lot. We see this a lot when we do restaurants, but we'll find that, you know, a rent might have been negotiated at the outset of a term for $30 a square foot. But by year 9 of the term or year 7 of the term, those leaseholds, which were, financed by the rent, by the face rent, are now largely depreciated. So it's unlikely another tenant would come in and pay that same $30 per square foot rent. So again, you know, these are important things to keep in mind. And again, required capital. There's a valid deduction in this template for buildings that need new roofs, buildings that need those leaseholds. And the only way, though, for the computer to learn is for somebody to tell it. And the only way for the assessors to tell it is if you tell it. So, so I get the next slide, please. Again, and this is another document. What you're seeing here is the PVSC's disclosure statements. So again, this system, the property tax system, has has grown a lot in the last decade or so in terms of the disclosure you get. These are, if you look closely here, I think it's big enough that you can see it. You can see how the city's divided up into lots of different communities. And what you're looking at is all the different types of rent tenants. So we've got large retail, small retail, grocery, fitness, pharmacy, different types of restaurants, bowling theaters, banks, everything else. So this is how the PVSC will calculate your rental revenue. So they'll choose the tenant that is most applicable to your building. They'll apply the rent from the neighborhood that's shown there, and that's what's going to be used to determine your potential gross income. But look, I can tell you right now that there's some opinion in this list here. I see small retail, I see tier 1, tier 2, and tier 3. So you need to ask yourself which tier you fall in. That's going to be highly an opinion, not just a fact. So, there's I guess what I would call one of those soft spots for negotiating reduction assessment. Next, we're going to move vacancies, and if I can get the next slide. Similarly, what you can see here is the city divided up into all different, different regions, and you can see the different vacancy rates that apply to each one. These vacancy rates, again, are averages. So to my question about whether you were in the 50% of properties that were too high or the 50% of properties that are too low, how does your vacancy stack up compared to some of these rates in your neighborhood? Similarly, how do your rents stack up against some of the rents that were modeled in the last question, in the previous slide? Those are the things that you will consider to figure out if you're in the 50% too high or 50% too low category. If I get the next slide. So lastly, we have the last two deductions. These are, recoverable expense allowances, non-recoverable expense allowances. You can see there's not a lot of variance in the non-recoverable piece. You'll see 5% across the board there. The recoverable expenses, on the other hand, really depend on how expensive a building is to operate. So again, do you have a case for a reduction because it costs your building more, it costs more to operate your building than the typical ones? Is your building completely uninsulated? Are the windows leaking and, bringing cold air in, so it costs more to heat? These are factors that can contribute to putting you in that 50% too high category. And the last one's cap rates. So you're going to see they've modeled cap rates across. They range anywhere from 6.75 to 7.5%, depending on the neighborhood. And actually, what you'll really, if you scroll to the far right, I know that's not really in in our areas, but you see non-peninsula, you see there's some discretion there. Ranges from 7 to 7.5 on the non-peninsula area and in Spryfield and Herring Cove. So again, these things, there is some discretion on these all these modeled assumptions that are built into the valuation. So if I could get the next slide, please. Okay. So that's a lot to unload. It's a lot for a property owner to kind of dig into that stuff themselves. I'm fairly confident that if I ask the average property owner what if they're building had a 2,200 square foot footprint or a 2,100 square foot footprint, it would be hard for them to know. So I'm going to give you some broad-based tools to help you figure out if you're in that 50% too high category. So look, the first one's year-over-year increases. If you've gone up by 10 or 15% and everybody else went up by 3 to 5, odds are you're in the 50% category, 50% too high category. Per unit metrics. So this is a real, I shouldn't say easy thing to calculate, but it's information that's much easier than going through that PIN report. So compute your assessment per unit. So, you know, if it's an apartment building, it's 50,000 a unit. If it's an office, it's maybe $150 a square foot. If it's a hotel, it's maybe $75,000 per room. And then compare that to similar properties. If you're 80,000 a unit or 150 a square foot, and everybody else is 70,000 a unit and $120 a square foot, you've probably got some nice anecdotal evidence that tells you that that your assessments on that 50% too high side. If you're looking at houses, there's a little bit more sales data together, so you can do a little bit more that way. But on the commercial side, it's very hard to figure that stuff out. So if I get the next slide, please. Next, I'm hammering this capital expenditures thing too. So because it's something that the assessor didn't know when they set the assessment. They didn't know you needed a roof. So if you did, that's one thing that might make it worth appealing and bringing to their attention. If you've had a major change in something, so you saw all those models over there with the different vacancies that are applied. Well, what if you suddenly lost a tenant and now your building's 20% vacant? Again, that could put you in the 50% category. Income's the same. You might have had, leases that were $15 a square foot suddenly renew at $10 a square foot. Perhaps it's because better products been built next door, or buildings have been renovated and now tenants are, getting more next door. So again, that's a great reason to file an appeal. Use. And generally when we talk about utilization, we're talking about, owner occupied type facilities. Maybe we're a printer. I think, you think of all the, especially when we talk to, bids, you have lots of different, businesses occupying buildings throughout your districts. You could have anything from, like I said, I use the example of a printer, but you might have, a deli or something like that, where suddenly they're not able to use their building the way they were before. Restaurants, if you're not using the seating area anymore, if it's more important to have a building that's constructed to allow for takeout, then the buildings that are constructed for dine-in, are less valuable than they were yesterday. Changes in traffic patterns, this happens all the time. Imagine, if you have a big convention center go up in your district, and that draws lots of foot traffic to a new part of the, to a part where that didn't previously get as much. That is great for that part of the district, but it also, impacts, the other areas of the district. Also larger, zoom out. If your entire district is seeing traffic drawn away to another part of the city, that might mean there's been a decline in property values as well. So these are all valid, valid considerations when you're weighing if you're in that 50% too high category. Lastly, we talked about the COVID stuff, so I won't drill into it, but think about what's happened with your property. It's certainly something that, that when you flush out the conversation, you're likely going to find some facts and some fodder for an appeal. So, and lastly, one thing to remember is when we talk about vacancy, when we talk about the subject vacancy, that's a physical state. So we're not looking at where your vacancy was a year ago on January 1st, 2021. We're actually looking at what your vacancy was on December 1st of 2021. So, if you've lost a tenant, that's the magic date that we want to look at when we are working out whether or not we have a case for reduction. Next slide, please. And lastly, math and methodology errors. We've seen calculations that appear to be correct, only to take a calculator out and add everything up and find that the math simply didn't add up. Secondly, we had those properties that are done income versus cost. Well, and the freestanding restaurants are a fantastic example. Well, which one should I be assessed with? If I'm assessed on income and a cost approach gives me lower value, well, hang on, I'm an owner-occupied property. I should be done with a cost approach. Or on the flip side, you know what? I'm a restaurant assessed on a cost approach, but I fit an income model better. So 100% you'd want to look at that and see if you have a case. We also look at inconsistent modeling, and that's something if you see what the neighbors are assessed with, if you get the disclosure, you can see that maybe you've been unfairly treated in terms of cap rates. Hey, I've got a 7% on mine, but somebody else has 7.5. There'd be something worth investigating. Land rates, why am I assessed at $241 a square foot downtown while my neighbor's at 125? That'd be something we look at. Impediments, required repairs, same thing. Even if that plays into your capital requirements. The next one you see is sales chasing. And this has been a huge problem. Greg sort of alluded to it, hey, if your building sells for, $10 million and it was assessed at $6 million before, odds are the assessors are going to look, that'll be a red flag for the assessor to try and move it a little bit closer to market value. They're supposed to be at market value all the time. But certainly anybody that's been following it, anybody that's bought and sold a property has, will have seen that, they really lag pretty far behind. So, and it's completely disingenuous to simply increase an assessment because it's sold. You have to have valid reasons for it. So the file review, for lack of a better term, should yield some errors before you see a substantial increase. Otherwise, it should follow the same trends as other properties. So that's something I'd be inclined to watch for, especially if you've bought a property. Next is classification. And this is a real tricky one, especially when you get into, where all of your, where all of the bids are located here. So classification simply means whether you get the residential, i.e. the low tax rate, or commercial, the high tax rate. It's almost a threefold difference between the two. So it's one to look just at class, just look whether it's, it's easy to know that a commercial property is all commercial, easy to know that an apartment is all residential. However, what about when we get in the split classes? How do we apportion it? What percentage should be residential? What percentage should be commercial? Is it by square footage? I don't know. I personally think apartments on the second and third floor are probably worth a lot more than the commercial space on the ground floor these days. There's so much appetite for residential development. So classification is something that's very, very important to look at. And lastly is development potential. And again, you're going to see this in all of your districts. How many properties are being sold for, their current use versus a developer speculating on putting something else there? And this really creates a huge problem. And it's not unique to Halifax. All big cities have seen this problem. A developer's buying this, this future, potential 20-story building that's going to go on the site. But if you're a commercial use on the ground and second floor, you're effectively going to have all of this untapped potential above your property being jammed down and called commercial. The reality is the commercial value might be quite limited, and that it's the airspace over top. All of that airspace perhaps should carry a residential classification. So this is something that, the development potential ties back to classification. So, this is something that's, on our radar. There's cases working their way through as we speak. And, we don't have all the answers yet because the cases are ongoing. But if you think it's an issue, it's certainly something that you should bring up. So, if you're not sure, file an appeal. You know how to get your assessment calculations. If you can't, ask for it. Review them for all the things I've told you. Next slide, please. And this is what happens next. you filed your appeal, the assessor's going to call you, you're going to have some informal discussions, and you'll get either a reduction or a confirmation, at which point you've got to decide if you're going to go to the hearing. The hearing, the onus is on you to prove that it's wrong. If you're not happy with it, you have another level of appeal to the Children Review Board. If you were in a cap situation, which none of you will be, we're talking about businesses here, but you need to go to the Supreme Court to have a cap reinstated. So next slide, please. And this is where my cue to turn things over to my good friend Giselle.
Thanks, Andre. So what's happening with the 2022 roll? I mean, I know the BID executive have had a sneak peek at what's going on, and many of you have received your assessment notices, but in the media, it's all of the news has been about the increase has been relatively moderate on the commercial side of things. Anyway, I know residential's up about 10%. But there's a whole lot of turbulence rolling around under the surface of a seemingly innocuous 2% commercial increase in HRM. And the figures in front of you are for the municipality as a whole, but the experience in the urban BIDs is the same or potentially worse than that. Apartments everywhere have gotten absolutely schwacked, but it was the retails and the offices that kind of surprised me. So next slide, please. So I thought that you'd each want to know what was going on in your own backyards, if you will. And so I'll start with Halifax's downtown. And Greg spoke a lot about the pandemic, and there's a proliferation of the most profoundly impacted properties obviously located here. And really that would be true for all of the urban BIDs. And as Greg mentioned also, PVSC reduced hotels by 15 to 20% at its own volition, reduced parkades by 20%, but that was only with some urging by a professional pain in the ass who shall remain nameless. But anyway, it's probably still not enough, and that hotel reduction might not be either. Very surprisingly, and we've talked about this a couple times, the PVSC hasn't moved restaurants, gyms, or nightclubs, at least not without some prodding by that very same professional pain in the ass. But the problem needs to be brought to the attention of the assessors. They don't know until you tell them. Also in the downtown, generally speaking, land assessments are up. And the impact of the pandemic, if it's going to be considered relevant for assessment purposes, is going to be reflected on the building. And there are a number, as my colleagues have spoken to, there are a number of different valuation techniques for doing so. You basically value the building, and then you apply some allowances for external or functional depreciation to reflect the fact that the building's underutilized or it's not designed properly, and so on. Interestingly, in the CBD, and when we talk about income producing properties, the impact of the pandemic is reflected in a cap rate. And Andre had shown you some slides showing what the cap rates were for some of the retail properties in each one of the BIDs, other than Dartmouth, by the way, Tim. We do have a similar chart for Dartmouth. We did present Halifax on the slide today, but there'd be an identical chart for Dartmouth as well. Anyway, what was interesting to me when I first saw the disclosure was that every business improvement district except for Halifax CBD saw PVSC hold their cap rates flat, but astonishingly, its retail cap rate downtown dropped by 25 basis points. So in other words, that seemingly innocuous sort of change, 25 points, increases the value of income producing property downtown alone by 4%. So that was quite interesting. So next slide. The North End. North End has seen a relatively large median increase. I know I haven't seen the numbers on the roll as a whole, Tracy, but in terms of the median, that number with which half the assessments fall above, half below, median's about 5%. So about 5% of the members in that district would be up by more than 5%. Really, the takeaway when we took a look at the assessments and assessment in the North End generally is that value increases are being driven by those redevelopment land sales, which as Andre has spoken to, may or may not be appropriate for use for valuation purposes, and in many cases can produce overassessment. This has been going on for a number of years. North End is very hot. Quimple's been very hot. Downtown's very hot. Spring Garden's very hot. But a lot of those land rates, when you're looking at value in use and looking at a property that's in commercial use, small commercial use, some of those land sales might not be relevant, and again, producing overassessment. And in my opinion, in the North End, probably there are a fair number of properties that are potentially overassessed before consideration of the pandemic. So that's something to think about. Next slide, please. Over across the bridge into Tim's neck of the woods, downtown Dartmouth's experience very closely mirrors the experience in the North End, and many of those same comments would apply here. Again, we're looking at about a 5% median increase, and that may not seem like a lot, but again, you have that. What that means is that you have half of the properties that would have increased by more than that. So 5% is quite a lot to swallow in 1 year, particularly when we're looking at the tax rate potentially going up on top of that as well. Of note in Dartmouth specifically is vacancy, office vacancy in particular. It increased across all classes between January of 2020 and January of 2021. In other words, in that 12 months leading up to the date of valuation. So that's something to consider. And that's unique because the other BIDs, things tended to be fairly stable. Next slide, please. So moving on to Spring Garden, I mean, a common theme is emerging here. But in the case of Spring Garden, there's an additional consideration, and that's last summer's streetscape program. It was announced before the valuation date and was ongoing at the physical state date. So it's a relevant consideration for valuation purposes for 2022. Going back 18 months or so, PVSC was very sympathetic to the plight of owners that were impacted by the crane collapse. And so I have every reason to expect that they would be here as well. Another thing to consider at Spring Garden is the issue, or the fact that Spring Garden is going to be bus only. The impact of that is yet to be seen. There's some risk there, we just don't know, and that can be incorporated into valuations via an increase on the capitalization rate. Next slide, please. Excuse me. So Quimple, we were chatting about this before we went live. But based on our sampling at Turner Drake, Quimple hasn't done too badly. The median increase would be less than 3%. The big story again here is values being driven by residential redevelopment. And you look at 3%, you think, well, gee, that's not too bad. But Quimple was hit year after year with a number of large increases in the early to mid 2010s in particular. So a lot of those owners are seeing incremental increases on top of what were large increases probably 5 years ago. Very, very high proportion, obviously, of retails and restaurants in Quimple, and for all of the reasons that Greg and Andre have spoken about, I think those warrant a closer look. Next slide. So tenant appeals. Just a brief note here about tenant appeals. Many retail and hospitality-oriented businesses, gyms and the like, bars, retail properties and so on are tenants of the buildings in which they're situated. And under Section 62 of the Assessment Act, and it's reproduced on the left-hand side of the slide, it's kind of small, but you can zoom in. Section 62 allows for tenant appeals provided the appellant provides notice to the property owner in writing. The benefit on a business-to-business basis will vary, and that really depends on the proportion of the building that you occupy. The larger the portion, the greater the benefit, obviously. It also depends on the method that the landlord uses to recharge taxes to you. In some specific instances, particularly with income properties, you might have your own line within that assessment calculation or your own modeling that, if you have that particular line of the assessment calculation reduced, some landlords do recharge based on that, which means you'll get the direct benefit of an appeal. So we'll take next slide, please. Okay, so we've talked a lot about the assessment side of things, but of course we know that that's only one side of the taxation equation. And so I thought I'd speak now to some of the tax changes that are being proposed by Halifax, because there are two. And I know the bids have been very, very involved with this, but for some of the other attendees today, you might not be aware of some of the stuff that's coming down the pipe. So I thought it would be, I'd be remiss if we didn't talk about it. So next slide, please. So the first change is assessment averaging, and this is moving full steam ahead, and I'd be 95% certain that it's going to be seen on your final tax bills in the fall. And so it's intended to provide some stability so owners aren't faced with those ups and downs, mostly ups associated with the property taxes increasing by double digits in a single year. My editorial comment is that it's fixing a problem that we saw 5 to 10 years ago. And although it's going to help some properties, that see large increases when they've been selectively reassessed upon sale, we see this happen all the time. Andre was talking a little bit about the phenomenon known as sale chasing. It's probably not going to have a huge impact. So in 2022 or 2021 rather, only about 10% of commercial property owners would have qualified for the program. My other comment, and this is just my personal opinion, not necessarily the opinion of my colleagues or of Turner Drake, it infuses a degree of complexity into the system and reduces the transparency, which is not a good thing. Actually, in that way, it's not unlike the cap, which is sort of brought in to address the same kind of problem, right? Those spikes in assessment. Anyway, what averaging might look like is seen on the left-hand side of the slide. And the way it works is this: any increase of more than 5% over the average of the municipality gets averaged over 3 years. I've attended focus groups with the city, probably 4 or 5 of them now. And there's some talk about setting that increase at a flat 5%. Right now, the way it's tabled, it would be if the average increase for the municipality was 2.6%, which was the average increase in 2021. Anybody with a 7.6% increase or greater would get that portion of their assessment averaged over 3 years. I'll get you to flip the slide, Kim, if you don't mind. Where it gets woolly is when you have these multi-year increases. So it gets increasingly difficult to decipher the tax bills, and that can be seen to the left-hand side of this slide. I brought this concern up to city staff. I said, geez, guys, if you're going to go ahead with this, you might want to change your reporting on the tax bills. Otherwise, no one's going to know what the heck is going on. They're not going to be able to understand their taxable values. And anyway, so what remains to be seen what will happen there. They recognize that could be a problem. Also of note about averaging, the program, as I understand it, is only going to apply to the first $1.5 million of the increase. So anything over $1.5 million fully taxable in the first year of the increase, but $1.5 million gets averaged. It's still evolving. And I have included a link to the city's information on the program here for reference for if anybody wants to take a look. Of note also, I guess, about averaging is that it's going to be revenue neutral. So for everyone who pays less, someone else is going to pay more. Next slide, please. So the second tax programming change that's being discussed are some options intended to bring relief to small business. And there are 3 different options that are being discussed right now at council. And I'll editorialize again here, and I'll say that they remind me of the old adage that, where you put 1 foot in boiling water and 1 in freezing water, and overall you're warm. It's kind of what these smack of to me. I'll be partisan. I really can't come out in favor of one or the other. We have clients that would be located in all of the various zones and that would be impacted to some degree by all of them. So I'll provide some basic information and maybe some editorial comments and talk about each one. So next slide, please. So option 1, which city staff, I should say, is not recommending, provides relief to BID areas where taxes are above the BID average. And what it does is it sees taxes reduced by 50% of the amount by which they exceed the BID average, if you're still with me. So if the average is $3.20, say, and Spring Garden is $5.20, it's a difference of $1. So Spring Garden's taxes get reduced. That a few of the urban BIDs would benefit from this, but generally speaking, there'd have to be a fairly sizable decrease or increase rather in the general tax rate to compensate, so about 10%. And again, it's the urban BIDs do see some relief from this program. Next slide. Then we have option 2. Option 2 is it arose because research by city staff indicated that commercial properties in that $1 million to $2 million value range had the highest taxes per square foot. And so it's designed to provide some relief to that segment. And under option 2, everybody pays less up to $5 million. So your first $1 million gets taxed at a certain rate. And these rates are detailed on the left-hand side of the slide. The next $1 million, it goes down even further. And then above that, you pay more. Everyone pays less up to $5 million. Once you get to $5 million, at a $5 million assessment, taxes are down about 7%. But after that, the larger properties pay more. And I've crunched the numbers at price bands increasing by $2 million all the way through. And the increases really aren't terribly egregious. When you go from 5 million up to 10 million, you're talking about increases somewhere from 1.5% to 3%. And even when you get up to a value of about 30 million, and I know, Paul, you'd have some properties in downtown at 30 million or more, Spring Garden as well, that increase becomes about 4 or 5%. So, an unwelcome bump, but not as crazy as I thought it would be when I first saw these numbers. City staff likes this option. And I guess on the pro side, it's easy to administer and it applies to everybody. I just don't think, again, I'm editorializing, but I just don't think it's targeted where it's needed. Businesses who own their own properties would see some relief, but the tenants might not. Okay, so next slide. There's good and bad in all of them, right? It's you know, you can find the good, you can find the bad. Okay, so option three was what was originally presented by city staff last summer. It sees properties in certain zones, so primarily business parks, charged a higher rate at values over $2 million. It provides tiered rates up to 2 million and then higher rates above that accrue to the business parks and industrial areas. And the takeaway, everybody pays less up to a value of about 2 million. Over that threshold, industrials end up the same as they would under option 2, but the business park properties pay more. And quite a bit more, actually. At a value of $5 million, for instance, the increase is about 8%, and then the increases go up from there. And at that third notional sort of $30 million breakpoint, that the increase is about 18%. So it's quite a lot. Anyway, what's happened now? Council has tabled discussion on these options for the time being. There's going to be a committee of the whole, probably spring, early summer. And so we'll all have an opportunity to provide some feedback and to speak potentially and provide feedback and have some say in the shaping of this option. If I had a crystal ball, I would probably say 50-50 at best of options 1, 2, or 3 going forward. I think they're going to need to, they being the city, they're going to need to iron out the kinks with the averaging first, but that's just my opinion, and I've been wrong before. So that brings us to the end of our structured presentation, and I guess I have 2 takeaways. One is on the assessment side: when you're in doubt, appeal. This side of the property tax equation is somewhere where you can, to some degree, steer the ship on your own tax burden. So you have about, what's today? Today's the 20th, so you've got about 20 days left to do that. So still lots of time, at least in my world, to take a look at that and get your appeal in. And if you have any questions about how to file the appeal or some assistance with that, don't hesitate to reach out to any one of us. Second takeaway, I suppose, would be that the tax options discussed in terms of those tiered options and so on have not been finalized, and they are going to go to the committee of the whole, as I said. So you'll have an opportunity to provide some feedback in writing, rather, to your counselor or in person at the COW itself. And with that, I will stop talking, and we'll open up the floor to questions.
Great. Thank you, Giselle. So a couple of years into Zoom, we're still learning new things. And one of the new things I learned today is I was going to put Giselle's email address posted in the Q&A for everyone to see. But as a panelist, we've got a separate chat, which the people can't see. But what I will say is it's pretty easy to find Giselle or her colleagues on the Turner Drake website. So if you go to turnerdrake.ca, is that right?
turnerdrake.net.
turnerdrake.net. You can certainly contact anyone there directly and go from there. So if there's anything that you want to ask kind of privately and not publicly. So we are monitoring the Q&A, and just so I'll give people a chance, if they haven't yet, to go into Q&A and post a question, and we may be able to open up for you to ask directly if you want to. But I would suggest, if you have some questions, type them in there. I'll just maybe do a very brief commentary, a response on the tax option. So there's been all of the bids. There's nine business improvement districts within HRM. There's only 5 of us on the call today representing the urban core, and we've got some colleagues in suburban areas. But for the past 5 or 6 years, our groups have been working collectively, and really what we've been trying to do is advocate for a common position on commercial tax reform, present that as a unified front to the city. So those options that did come forward, option 3 does represent really the closest to what we would prefer to see. And so anyway, we won't get too much into that today. That's not necessarily the topic. But rest assured, the business improvement districts are working hard on the commercial tax reform piece. We are planning to do a presentation to committee of the whole when the opportunity comes. So certainly, if you have any questions about the commercial tax reform piece, reach out directly to your local bid leader, and they would be happy to engage with you on that. So back to assessments and appeals. As certainly when I click on the Q&A, I'm not seeing any questions, which maybe is the sign of an excellent presentation that just simply leaves nothing required for clarification. And if that's the case, we can let people go. But if you do have any questions, I would encourage you to put those in there. I have one that I can start off with while we're waiting for some other ones. And it was just a clarification on the CAP program. So my understanding is that the CAP program, my understanding is that only exists within the realm of residential taxation. But I thought someone mentioned it in regards to commercial taxation. Did I just mishear?
No, I think what I was saying is that I think the averaging regime that's being brought in is attempting to do the same sort of thing
Right.
that the CAP program did, just in a different way,
Right. Okay. Thanks.
just to try to smooth out those increases.
Yep. So we see Tracy Jackson has her hand raised. So I'd say Tracy, just turn your camera on and come back in.
I figured I'd raise my hand. Yeah, so I just have a quick question. I'm wondering if you have any information on how, like what percentage of appeals are usually successful?
I can speak from our own experience. I would say the vast majority are, because we tend to do a fairly thorough review before we file an appeal. So we know that there are grounds before we get into things. And if we're not successful on an appeal, oftentimes what you see happening is the appeal processes can be fairly long. So what happens is, for instance, 2021, you file an appeal. By the time the appeal is up for discussion, the 2022 value is available, and you're able to potentially secure a reduction for the following year in exchange for conceding your appeal. So in time, I would say close to 100% would be successful, provided you've had a look-see before filing that appeal.
And what is sort of the average amount of time that that a person would have to wait to get
An answer?
an answer? Yes,
Yeah,
thank you.
I mean, the process takes some things are it really depends. You know, with the pandemic, things have been very slow. People are working from home. One thing I find about the pandemic, we haven't had that opportunity to sit down face to face with assessors, and that's a great way to resolve things, right? And when you don't have that ability, it tends to drag on. Typically, in a non-pandemic world, I would say 6 to 8 months, and you generally see yourself get through that process, sometimes quicker. If you have to proceed to a hearing or a tribunal, it can sometimes be 8 to 12 months. But I do know that we have a large number of appeals that have sort of pushed over that 12-month time frame right now. But I would certainly say, in usual circumstances and in a normal world, you'd be done within the current assessment cycle.
And so in that, sorry.
Oh, no, it's okay. So the municipalities start getting a little cranky when appeals are, obviously, because it's a budgetary concern. So they like to see the appeals wrapped up within a reasonable time frame as well.
And so does an assessor come out to every appeal and look at the property and do their own sort of judgment on what that person had submitted, or is it just, do they just sort of look at data that they might have from their desk, sort of thing?
Kind of a combination of both. I would say probably half that, 50% of the time the assessor will ask to come and take a look at the property. Oftentimes, if they don't, we will invite them to come and take a look at the property, because there might be things that, you know, that they weren't aware of. And sometimes the curb doesn't tell the whole story. You can't see that areas are underutilized or there's repairs or whatnot from the road. I'd say 50-50 probably. An income producing property, less so. You're more focused on the rent roll from the property and the expense profile and that sort of thing.
Thank you.
Go ahead, Sue.
Thanks.
Oh, you're muted, Sue.
I'd get this. You think I'd get this straight after 2 years? Giselle, I just wanted to expand for my education a little on the landlord tenant relationship when a tenant goes to appeal their assessment.
Mhm.
Do you find, in fact, that most landlords don't like that system? Or that's my first question, because it kind of goes to the relationship of landlord tenant. So for example, if we did the Trillium where the crane collapsed, and then everything that's happened last year, you know, for example, I have a hair salon in there, again, back at 50% capacity. Does that appeal lower the value overall of the building itself, but not, so that's question A. And B, there's no guarantee, I assume the answer is yes, that the landlord is not going to pass that savings on to the tenants. And two, my second question is, and I had this a lot last year from those that appealed the commercial assessment. In the final back and forth, the question was asked from the panel 3 times to 3 different properties in my area. But wouldn't you sell the building if you could get that price? Like how does that relate? I mean, I get that all the time on the residential side because I've appealed my property. So that's what I get every year. And you leave and you're going, well, I'm toast now. So thanks.
Okay, so to your third question, there's a reassessment in Nova Scotia is annual. Okay, so the assessor is required under the case law to look at conditions as he finds them at the date at the date of assessment. So if your property has a lot of redevelopment potential, the price might be driven by that. And yes, you might not sell it for a certain price. However, you have to look at what is it worth in its existing use, not necessarily if a developer comes along and builds a 12-story building over it. And the case law also holds that valuation for assessment purposes is by necessity a conservative one. So you're not trying to look to the highest value you possibly can. It's a reasonable value for what's sitting on the property on the base date of assessment. So I would say that a lot of these, if you're looking at these higher prices for a commercial property, a lot of times that's reflective of latent potential. It's speculative sometimes to say how much latent potential there is. And I guess the other thing is how much would somebody be willing to pay for the property in that use, right? If it's a ground floor commercial with an apartment over it, in spite of the fact that you can build over, what would you pay based on the income stream from a ground floor retail with an apartment over it? So that's kind of, and we've met with some success with that argument. It kind of goes to what Andre was saying too. If the property is as it sits is worth $1 million, but it's worth 10 million if you build over it, well, $9 million of that isn't commercial. That's the ability, it's the value of the airspace and the ability to build residentially. So I would argue even the worst case scenario, if it's worth $10 million, that $9 million should be taxed residentially and not commercially. So that's kind of the third question. You'll have to refresh my memory on the first and second part. I'm sorry. You're muted again, Sue. Sorry.
Yeah. So I guess my third question is coming out, when we go back and forth on these appeals, and in the end, the board or the panel says, well, if you wanted that, right? So don't appeal your assessment. Basically, you could get the value for that. So what's your complaint?
Yeah, it's market value the appeal process in Nova Scotia is tough, right? Because the onus is on the appellant to prove it. And that's a really difficult comment to counteract. I find that we would meet with more success when you sit down with the assessor and have a face-to-face and discuss the assessment before you ever get to that stage.
Yeah.
Because there's a very, very high burden to meet once you get to these tribunals. And that's part of the reason why it's difficult to sort of crack and get a reduction. But assessors are reasonable people. And if you can explain to them that, listen, I might be able to sell this down the road, but as of right now, this is the income that I'm getting, and this is what the property is worth capitalized. So my advice to anybody is to try and get in at the ground floor. If you can discuss it in the fall, before the assessment even becomes public, that's an even better way to do it.
Yeah. And as Tracy pointed out, mine was about the tenant landlord relations.
Oh,
So
right. Yeah.
So you've got to inform your landlord that they're going to appeal. I'm just worried if a landlord's upset and then is going to rent evict you out of the place.
Yeah, most commercial landlords are reasonably are reasonable, and most commercial leases do have a provision dealing with the appeal of taxes, whether or not you have appeal rights or not. If tenants have any concern as to what the reaction of the landlord might be, it might not be a bad idea to reach out ahead, and say, look, you know what, my sales are down 50%. I'm thinking of filing an appeal. I'm required to notify you in writing, but I just want to give you a shout, let you know that this is what I'm up to. And would it apply to the whole property? It depends. And I spoke about this a little bit. I don't want to get into the weeds too much, but it really depends on the recharge method that the landlord uses for taxes. So sometimes it's proportionate share. So let's say a property is worth $1 million. Your little slice is 200,000 and you reduce it by 50,000. That $50,000 reduction in the taxes, if the landlord recharges the taxes based on square footage, everybody benefits. Whereas if you have 3 lines in the calculation, one for restaurant, one for retail, one for apartment, and you reduce the restaurant portion of it, and the landlord recharges you your taxes based on assessment, which is a fairly common method of doing it, then you would see the benefit.
Thank you.
I see we have in our Q&A, it's actually a comment from our friend Ross Cantwell. Ross doesn't like to follow the rules anyway, so a comment instead of Q&A. Ross, we're going to see if we can unmute you, and you'll know in a second. I guess we'll all know in a second. And I think you've popped up on our screen, so I think you're live, Ross.
Yep. Okay. Oh, just wanted
There you
to.
are.
Hey, Giselle. Just wanted to provide a comment. I've used Turner Drake for a number of years to do all my property tax assessments. I got a degree in accounting. I was a certified public accountant. I worked as a real estate consultant for 25 years. I even worked in the appraisal industry for a while. This is all a big game, and you have to understand how the rules work. Some of the relationships that Giselle and the others at Turner Drake have are very, very good with the assessors. They know the rules better than the assessors do. So my experience has just been fantastic with Turner Drake. And what they'll typically do is say, yeah, no, we took a look at this one. We don't think there's much of a grounds for appeal. Don't worry about that one. Don't worry about that one. But look, these 4 over here, no, I think we can definitely do something for you. And off they'll go. And then, 19 times out of 20, they'll come back with tax savings. So I highly recommend them to anyone else out there. I know this whole thing is a bit confusing to people, and the trap people shouldn't fall into is, oh, my property, I know I can get $1 million for my property and it's assessed for 850,000. I guess that's okay and I shouldn't appeal. That's bad thinking, because it's all about the ratio of your assessed value to market value, and whether it's high or low compared to everyone else around you, and a bunch of other things. So I highly recommend them, people.
Ross, thank you.
Thanks,
There we
Ross. I
go.
think it's
I didn't get
it's only
paid to do that.
I think it's only fair to let you know, Ross, that we're not paying Turner Drake for today's webinar, so there's no opportunity for a kickback for you. But good comments. Thanks for those. Really appreciate them.
Excellent. Okay, thanks.
Okay, I sense that we're kind of wrapping things up, but we can give another couple minutes if there's any other burning questions or comments people, the audience at home wants to post in the Q&A, or anything else from our from the business improvement districts.
I would add that if anybody's a little too shy to speak up, more than happy to go offline with any questions that people may have, either myself, Greg, Andre, my other colleagues in the tax team as well. Anytime.
Great. Well, I think, oh no, I see the Q&A has now jumped to number 3. We have, it's just, oh, sorry, it's a comment from Derek. I'm not sure if Derek wants to come on or not, but I guess let's read it. So he understands the point Sue's trying to make. Yes, you would probably sell the property at that price, but the issue is how unfair the tax rate is, especially for commercial. At almost 4% on commercial, it feels extremely unfair for commercial property owners. So that is a good point. We didn't really delve into that. It's kind of more of an advocacy piece, but I know certainly groups like the Chamber of Commerce and the business improvement districts, both here and in other cities, there are some real issues in terms of that disparity between the residential rate, and we saw it there. It is about 4 times, commercial rate's about 4 times what the residential rate is. I know some other jurisdictions, and correct me if I'm wrong on this, I know that New Brunswick, for instance, actually has that differential, I think, capped at 2.5 times. So the commercial rate can only be a certain amount higher than residential rate. I know in Toronto, I think it was 8 times at one point in time, and they've kind of worked through a system to kind of close that gap. So I think it's a whole other issue, but it certainly is a significant one, and one that the business improvement districts and some other business advocacy groups continue to lobby for. Is we do feel there should be that, that probably it's fair that commercial does pay more, but what is that difference? And 4 times seems like a lot.
Yeah,
Giselle, I don't know if you want to comment on that comment, but.
Yeah, but I could. What I will say is that I've been involved in this the tax reform game for a very, very long time. I know Sue and I spent an immense amount of time on this back in 2005, 6, 7. And commercial taxpayers in HRM pay about 150% in taxes of the cost of the services they consume. So there's a cross subsidy, right, on the residential side. Residential is only paying about 80% of the cost of services that they consume. So certainly I think that there's some room to narrow that gap for sure, to Derek's comment. And back in the heady days of tax reform, we were advocating more for a cost-based system, right? That would tend to narrow that gap, didn't really go anywhere. But anyway, it hasn't left the radar, Derek, and I know that as Paul said, the chamber's looking at it, the bids are looking at it, and certainly those of us who are active in the tax policy field are looking at it too.
Yeah, and the rates certainly they lie, completely within the purview of HRM. So again, it doesn't matter for your councillor and the mayor. That's something that the municipality can change. It's got really nothing to do with PVSC, who just kind of sets the overall valuation of your property and assessment. But anyway, a good point and an important one. All right, last chance. We can let everyone go about 15 minutes early. And again, we're happy to answer any questions. And certainly I know Giselle and the Turner Drake team are happy for you to reach out to them directly. All right. Well, on behalf of my colleagues, I'd like to thank you, Giselle, and your colleagues for today's presentation. And again, it's something that seems more relevant, I think, because of COVID, but it's probably something we'll look to do on a fairly regular basis as well. So thanks very much, everyone, and have a great rest of your day and week.
Thanks, everyone.
Bye.